All right, guys, so welcome to this teaching. All right, so if you have not gone through the previous lectures, do also go through the episode lecture 1 to lecture 8 or lecture 7. Sorry, this lecture 8. Please do want to go through it. It's inside one playlist. Just go to the playlist section of this channel and click on playlist. You will see the previous videos that preceded this one. All right. So welcome to this teaching. If you have watched the previous one, you're very welcome. I hope you have found value, and I believe you will also find value in this one. All right. So now we're going to go into a very, very serious topic now, right? So I talk about market structure, breakout structure, all this fun stuff, right? Talk about risk Fibonacci, discounts, premium, all those things, right? So for the sake of today, we're going to go into something very important, and that's what multi-time frame analysis, right? I think I spelled this wrongly. Multi-time frame analysis. All right. So what is multi-time frame analysis? This is simply doing what? Putting or multi-time frame analysis. And this is simply putting what? Putting the different time frames in perspective, right? You know, in every market, every different time frame is telling a different story. For instance, now you can look at your daily chart, right? And your daily, right? This is your daily now. Your daily can be giving you what? A bullish structure. So on the daily chart, you can have a bullish structure. Market is making higher highs and higher lows. And inside this retracing leg here, right? You can see the 1 hour giving a something different. So now inside this leg here, inside this leg, you can see the 1 hour doing what? Being bearish, because the daily is what? Retracing, right? So you can see the 1 hour giving what? A bearish leg. So inside this move down, you can see the 1 hour looking like this, looking very bearish, making lower highs and lower lows. You can see this happening on the 1 hour, right? This is the 1 hour now. And inside this 1 hour now, the market is retracing, the form is low, or its form is high. So inside this 1 hour leg now, inside this 1 hour retracement leg, if you look on the lower time frame, inside this 1 hour leg, this small pullback, right? This small pullback here, right? If you look at the 1 hour, you can see that on the lower time frame, let's say on the 5 minutes, let's say 5 minutes time frame. So on the 5 minutes time frame now, this whole move that looked bearish on the 1 hour can be now be what? Bullish on the 5 minutes. So you can see the 5 minutes time frame looking like this, right? So every time frame has a different story printing. Each time frame is telling what? A different story. So inside the daily, the 1 hour can be bearish, and inside the 1 hour, the 5 minutes can be bullish, and inside the 5 minutes, 1 minute can also be bearish. So you have to understand that different time frames have a different story they're trying to print. So it's your duty as a trader to be able to merge the different time frames and have a particular bias, right? Because each time frame is telling a different story. That is why I find it very absurd and funny when I find some traders saying that I focus on only the 1 hour, I focus on only the 5 minutes, or I focus on only the 10 minutes. I am wondering, what about multiple time frame analysis? How can you be focusing only on the 1 hour or focus only on the daily? What about the higher time frames? Because the what gives you the higher odds or higher or better understanding is to be able to put in the perspective of the different time frames. You must understand what the different time frames are saying. All right, you have to understand what the different time frames are saying. You have to know what the daily is saying. You have to know what the 1 hour is saying. You have to be able to put all these things into perspective before you can able to build your bias. And it's very, very important that you do that. Very important that you have your bias. All right, very, very important. So it's very important that you have a bias. Right. So now, understand that different time frames tell different stories. Now, what is multi-time frame analysis? Right? What are you doing or when you look at different time frames? What you're trying to do is what? Your goal of multiple time frame analysis is to correlate the time frames, right? So you want to correlate, right? You want to correlate the time frames and have a particular bias. So your goal of multiple time frame analysis or multi-time frame analysis is to correlate the different time frames to have a unique or a specific bias. So you want to have a bias. Now, what do I mean? What do I mean? So now, as a trader, the best probability you can have is when the time frames are correlating in your favor. For instance, now, if you are bullish, right, I want to see the daily bullish. This is your goal as a trader. You want to see the daily bullish. You want to see the 1 hour bullish, right? I want to see what the 5 minutes bullish, right? I want to see every time frame giving what the same idea. This is what your goal as a trader is. I want to see the different time frames giving what one particular bias, daily being bullish, 4 hour being bullish, 1 hour being bullish, all the time frames giving you what at least 3 time frames have to be saying the same thing. At least 3 time frames. So you have to have a higher time frame, an intraday time frame, and a lower time frame or an entry time frame. So you want to see at least 3 time frames. I'm not saying it must be 1 hour daily and 5. I'm not saying it must be daily 1 hour 5 minutes. It can be daily 4 hour and 1 hour. It can be daily, weekly, and 1 hour. So at least 3 time frames have to give you what is unique direction. So your goal is to make sure that the daily is bullish, the 1 hour is bullish, the 5 minutes is bullish, and that is what your goal is to do. So that these things are having what a unique look. All right, they're looking alike, right? One of your time frames are having something what similar. So how do you put this thing together? How do you put it together? Simple. When the market is bullish, right? When the market is bullish, right? Understand this. When the market is bullish, right, on the daily, and markets come to retrace to your to your form to mitigate what's your other block, right? So now when the market comes on a daily, right, to come to hit your POI, right? Your goal as a trader is to do what? Is to wait for the market to align. So the market is now the market is bullish on the daily time frame, right? And then you have what your higher low, maybe your other block, right? You have the other block here. I'll talk about other block as we continue. So markets comes to form its higher low, right? And you're bullish. You have a bullish bias on this market. You're bullish on this market, right? The market is bullish. You're having a bullish bias, right? So now, if the market is bullish, what you're looking for on the lower time frame, let's say maybe on the 1 hour now. Let's say on the 1 hour. So on the 1 hour time frame, what are you looking for on the 1 hour time frame? Very simple. You are looking for the market to give you what a similar change of card. So on the 1 hour now, when the market hit your PUI, what do you want to see? You want to see market do what? Change from being bearish and become what? Bullish. So we're looking for what? A break of structure on the lower time frame so that the daily can be looking like what? The uh, the 1 hour can look like what? The daily. The daily is bullish. So market is only retracing to come to form its higher low. So as market has come to form its higher low, on the 1 hour, you want to see market what? Break and become bullish. So once the market becomes bullish on the 1 hour, then you now have what? Your trade. You're gonna take the market higher. And as the market is going higher now, you are seeing that the daily now is now similar to what the 1 hour. All right. So now the daily is now what? Similar to the 1 hour. So once the market breaks on the 1 hour, then you are anticipating what? Bullish price action, right? So you now want to see the 1 hour doing the same thing with what the daily. So once the daily comes to a point of interest, you go to a lower time frame and wait for the market to do what? To break in the same overall direction with what? The daily chart. You want to see the 1 hour printing the same structure with the daily time frame. That is what time frame correlation mean. You want to see the ideas printing and looking alike. So if you inside this move now, inside this 1 hour move now, inside this move here. Sorry, don't do that. So inside this move here, we want to also see the 5 minutes doing the same thing. So as markets came inside this area, right, on the 5 minutes, or let's say the 15 minutes, we want to see the market do the same thing. The market break and become what? Bullish. So you cannot use maybe the 15 minutes for your entry, or if you want to use 1 hour for your entry. That is basically what you're doing. You mark out a higher time frame area of interest and refine it to a lower time frame and wait for the market to break structure in the overall direction of the daily chart. So you're not trying to sell this. The market is bullish because the market is making higher highs and higher lows, right? So you want to make sure that everything you're doing is what? Aligned. So now as the daily is what? Is printing bullish, what do you simply do? You wait for the market to what? Break bullish back on the lower time frame. So you cannot do this. You can do this is just the simplest way to trade. When the market is bullish on the daily, wait for the market to break back bullish on the 1 hour and then maybe 15 minutes for your confirmation, and then you use the lower time frame for your entries, and then you're trading in line with what the higher time frame. So you're not catching what this whole bullish push, because why? You waited for what the time frame to correlate on the lower time frame. All right, so you have to learn how to correlate different time frames. All right, let me come again. Now, let me also recap. On the daily, the market was bullish, right? As the market is coming to form its higher low to make a new higher high, you go to what a 1 hour or a lower time frame, maybe it could be 2 hours or maybe 3 hour or 4 hour, right? And wait for the market to break and become bullish like the daily. Because when the market was coming lower on the daily, the market will be bearish on the 1 hour. So for you to get your correlating bias, the market has to come to the daily higher low and then break structure to form what a bullish structure, which is on in line with what the daily. So the 1 hour is now looking like what the overall daily time frame. And then if you want extra confirmations, you can wait for maybe the 15 minutes time frame or the 5 minutes time frame to also break bullish, and then you use the retest of those of the 15 or the 5 minutes time frame for your entries. Is that simple? That's simple. Nothing so rocket science in this. It's just easy. Just know how to merge the different time frames, right? So let us look at a quick understanding of the real chart, right? This is now, let's look at this move here, right? Now, this market was bullish, right? Let us look at this price action for me. Look at this price action, right? Market was bullish, right? Market was bullish. So watch this market now. The market, this is for you guys that don't know, this is a volatility index, right? I just plan to use this because we're talking about the volatility index in the next class. So I just want to just see what it looks like. All right, so now the market is bullish, right? So the daily is what's bullish. So you can type in that daily is what's bullish. So you can say daily is what's bullish. So this daily is what bullish, right? Right. So daily is bullish. But if you look at this market, as the market was retracing down here, right? The market was still bullish, right? Because why? What can you see that makes you think it's bullish? Why? Because you can see higher high, higher low, higher high, higher low. You can see how the market is bullish, right? So now inside this pushback, right, this pullback, if you go to the 1 hour chart, what are you going to see there? Watch what you will see on the 1 hour. What I've just been telling you guys about. Right. Let's just go to that area. So you can see that in that push down, what do you see? Can you see what talking about? I'm telling you guys about. So in that push down, what can you see? On that daily pullback, you can see that the market is what bearish. Can you see the 1 hour that in the on that daily leg, the 1 hour is printing what bearish. You can see that the market is what printing bearish. You can see it very clearly. You can see the market is printing bearish on the 1 hour. You can see this is how it looks like on the rate chart. You can see it is printing what bearish. This is how the markets look like. The daily is bullish, but now the 1 hour is bearish. So now, if you go back to the daily, you can now look out for what you're not looking for what a break of structure on the 1 hour to align with what the daily. All right. So now, if you go to the daily time frame, you will see something very beautiful there. All right. If you go to the daily time frame now, you're going to see something very, very beautiful on the daily time frame. All right. Sorry, I had to reload it because sometimes video refinds it difficult to just show the chart until you reload it. All right, so this is going to be a very beautiful teaching. It will really, really bless you guys. To really bless this teaching will bless you guys. All right. So now this is that 1 hour chart again. Remember, so this is how that bullish push. Now the market was bullish on the daily. Remember, don't forget that. So now if you mark this is a higher low. This is the other block area that we're looking at. Okay, market was printing bearish. So now this is the area you're looking for what the market to buy inside this other block, right? So now let's go to the 1 hour and see if there was an entry on the 1 hour. That thing you're looking at for on the 1 hour. Right? So you have to mark out the PY and all of that. So I'm thinking you can about to the PY as you continue. So now watch what happens here. Let's watch this beautiful move. All right, watch this. Look at this. See, as markets came to our daily point of interest, what do we see? Do we see a break of structure? Yes. So we had what our break of structure here. All right, and the markets came back to retest this area, right? Markets came back to retest this area, and then what happened? The market bought. So I said that was only what a break of structure was a retest to what this same other block again. Markets came in the other block 2 times, and then what happened? Markets started pushing what higher, 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 higher. Because the market now changed from being bearish on the 1 hour to what doing what bullish. This is how you correlate your different time frames. It's not a rocket science. It's that easy and that straight to the point. It's not that difficult. So you have to learn how to identify what the different time frames are doing and be able to correlate it. And be able to merge these things together. Right. Now let me just give you guys a very sweet thing. Now let me point this out. Now you've understood time frame correlation. Now what happens when if you want to catch a retracement, right? If you want to catch maybe a pullback, right? So now maybe daily is what bullish, right? The daily is bullish, and you want to catch that little sell. Let me just give you guys a teaser now. So if the market is bullish on the daily, I want to catch that retracement sell. Like as my market is bullish now, I am planning to catch for this retracement, right? I'm going to catch this retracement on the daily, right? This is the daily time frame, and market start to retrace, right? We want to catch this pushback because the data even takes time to print. So that's why you want to catch this pushback the downside, right? What do? First of all, you wait for the market to take out external liquidity. So when the market take out this liquidity here, this old high, then if you want to catch the sales, remember that a high probability buy is what at the 50%. So you cannot simply mark 50%. I'm teaching you guys wisdom now. So you cannot simply mark 50%, right? And then you know that the market should come back to 50% before it buys again. So that is the high probability. The market should at least come up with, or this is very, very risky. Note, this is risky because it can bite you in the backside, right? But on the daily time frame, market is bullish, but it has gone above the previous high and it's not retracing. So inside this retracement leg, you can still look out for what a break of structure. So market can, when market will do something like this, break structure, and then you cannot catch this sell. But remember, this sell is a short-term sell. Remember, because while the market is still bullish, so above a previous high, you can look for what a counter movement above a previous high. So if you're bullish, you can look for a sell. Once the market takes the previous high and gives you what that 1 hour break of structure or that 1 hour confirmation, then you can look for what a sell. All right, this is what we call counter trend. So on the 1 hour now, you can look for what this. So now you can answer that okay, on this market now, the buys becomes what? The buys become what? The swing trades, why the sells becomes what? The counter trend, right? Counter trend. So you can, if you want to catch sales, it's now to call counter trend. All right, counter trends trade. So the buys are swing trades, why the sells are what counter trend. So you're not trying to swing the sales. You just maybe cash it for a while and then you're targeting 50%. When market 50%, you're done with your sales. Right? That is just the easiest way. And the reverse is the case for a bullish scenario. So the market is bullish. So the market is bearish, sorry. The market is bearish now on the daily. When the market makes a new low, right? The market makes a new low, right? When the market goes above this previous low, right? On the daily, you cannot look for maybe a 1 hour break of structure below the low. So as the market is coming back to form its new lower high, you cannot wait for the market to do this, to give what that bullish break of structure, that bullish break, right? Sorry, you can wait for the market to give what a bullish break. Inside this pullback, we're going to break structure, right? We're going to break the previous high. When the market breaks the previous high, then you have what? Your break of structure to do to look for buys inside this pullback. So the daily time frame takes a lot of time. So you cannot always wait for the daily time frame to do what? To come all the way to what? The higher low before looking for buys. It takes a lot of time for daily to move from the higher high to form a new higher low. So you cannot look for what? 1 hour change of characters above or below previous high. So let's just look at another example. Now let's look at back to the daily time frame. All right. So this student few kinds of gives issues when you have been on the time frame for a long time, right? So let us quickly reload it again so you guys can have a better understanding of feel what I'm doing. I'm about to round up now. All right, so you guys understand just this. Now, remember that same idea. As markets went above this previous high, let us say market went above this previous high on the daily charts. Remember, so remember the market was bullish. Market went above the previous high on the daily. Above here, you can look for what a 1 hour break. So let us see if we had a 1 hour break inside this area, right? This up movement. Let's say you had a 1 hour break for a sell counter trend trade. So remember putting everything together now. So remember that. So let us go back to the 1 hour again to see if there was actually something on the 1 hour that's just okay. Now remember that you're looking for the sales at least 50%. So you can also withdraw if you actually to swing high, you're swinging. So you're looking for a sales maybe at least to the 50%. So you can look for sales above 50% above the previous side. That's the counter trend trade, right? So let us see if there was one. Because if there was a break of so there was one I can see there. What do you have here? How the market was breaking structure here. So that was the break of structure right here. Market broke structure here. Market broke structure was not really very clear on the pullback, but we still had beautiful sell push. Market broke structure somewhere around there. And market came, retraced. The starting what? If you want to maybe of course this there are beautiful sell opportunities here. You can see all these lower highs and lower lows. So beautiful sells inside there. You can see the market was printing bearish, giving what those beautiful sells. And then at least you remember you're targeting 50%. So market gave a lot of beautiful sells. At least the market came to what? That 50% level. So I see market gave very, very beautiful sales, very, very beautiful sales inside that point, right? So that's how to merge different time frames, right? So when market takes out a previous daily high, then you can look out for what? A counter trend trade. But until the market does that, you have no business looking for counter trend trades. Counter trend trades are only after market takes out a previous daily high or a previous daily low. As long as the market remains inside the bullish range, as long as the market is here, this is the market is bullish on the daily now. Market is bullish on the daily. As long as the market is still trying to, as long as the market remains below what? Below this high, right? As long as the market is not, has not taken out this high, you can look out for what buys. So as long as the market is still inside this bullish range, it's trying to make a new high. As long as the market has not taken out this new high, what you're looking at for what is bullish price. So you're looking for what buys. You're looking for buys on the 1 hour. Keep looking for buys until the market does what? Takes out what this high. Once the market takes out this high, then you don't have any bullish sentiment. So this high becomes an area of interest. Once the market is able to do it, to take out that high, then you should not look for buys yet. On the market can take out this high. When the market remains below this high, you can look for what? Buys on the lower time frame. You keep buying on the lower time frame until price what takes out this previous high. All right. That is how you should treat your trading. Once the market takes out the previous daily high, then you don't have any bullish bias. So once the market comes to a higher low and it gives what that break of structure, right? Then you start looking for what? Buys on the market. Once the market gives that lower time frame break, when the market comes to a higher low now and gives that break, this is the higher low, this is the other block. When the market comes to this other block here and gives that break and start going back up, you keep buying, keep buying, keep buying until price also takes out this high. Once market takes out this high, then you can look for what? For counter trend trades, which is really risky because counter trend trades sometimes market can do this, can do something like this, it can break structure on the lower time frame, can do like this, break of structure. Right? This is why you should be very careful of counter trend trades. Market can give a BOS on the lower time frame since it's bullish and still do what? And still go higher. So it happens very well. So you have to be very careful of this because counter trend trades are very risky. Very, very risky. So you have to be very, very careful of counter. So for counter trend trades, you can wait for 4 hours to break. So 4 hours is more of a preferred time frame. So you can wait for a 4 hour time frame to break. Maybe daily is bullish. Once 4 hour break bearish, then 4 hours is very significant. So you cannot use a 4 hour break to do what? To take your counter trend trades. So it's not advisable that you always try to catch counter trend trades at the beginning. Always for the higher time to align, and then you have a higher probability trade in your favor. Right. So see you guys in the next teaching. Do want to like this video, subscribe, and I would love to have you guys in the next teaching.